Hi, everybody, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. If you happen to have missed last week's FANG Friday, I would suggest you take a moment and review it. As after a long time in my doghouse, during which time the stock did perform poorly, I had placed a buy recommendation on Apple after it reported due to its $110 billion share buyback plan for the reasons that I laid out last week. What this means is that essentially the SVA methodology has placed a hold buy rating on every one of the FANG stocks, perhaps save one, Tesla. And if there's a hold buy on all or almost all of the FANGs, then I think you know what this must imply for the market as a whole, meaning the NASDAQ 100 and the Standard & Poor's 500, as the FANGs are not going to go their own way without lots of company. Now, there is one important thing to observe and keep very much in mind. When you look at an SVA chart, you can see the fair market value line. That's that dashed blue line on each chart. And you can't miss the fact that every single one of the FANGs is trading well above its own fair market value measure. And this goes for the overall NASDAQ 100 as well. The FANGs and almost all of the NASDAQ 100 is speculatively priced. What I have observed in the past is that in past bear markets, that gap is always closed by the price coming down to the fair market value. Anyway, more on this after I have reviewed the 8 FANGs. For now, let's take a close look at all the FANGs and what went on in the past week. As always, before I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. And if you would like to learn more about our valuation service, go to www.strategicanalysis.ca. Okay, let's start off with Amazon. Nothing to say here. Amazon just continues to thread the needle, as it were, and the balance sheet is growing at a nice, healthy rate. So obviously, we are staying with this company. Alphabet. Well, Alphabet's actually had a very, very nice run, and more so recently when they announced not only a big share buyback, but also an initial dividend. So the stock is kind of getting up there. Well, getting up where? Well, it's getting up back to the former high that it had had, certainly for the past 10 years, actually for much longer than that. So it's getting up there. And why would we be concerned about that? Well, all we have to do is take a look at Meta and what happened here. And look what happened here. Every time Meta got up to its old high, it set back, except for the last time, when we had a very nice and very surprising record, and the quarterly report, and the stock actually broke out. Well, here's good numbers and a gap, good numbers and a reverse gap. However, the stock is scrambling back on side, and it's going to be interesting to see in light of its own history if it can hold here. However, for the time being, it's on side. I never got a chance to issue a sell on the stock for the drop because it had broken out and because it had great numbers. Microsoft, like Amazon, just continues to cheerfully thread its needle. It's going to be interesting to see what happens if it gets up to its HB2, which is 12 times book value. certainly as the key linchpin AI stock. I think I would have to hold the stock. Netflix, well, Netflix, interesting, eh? Great numbers, gap. Great numbers, gap. Great numbers, oops, gap, but the wrong way. However, after failing to break out, the stock has been oozing back up again, and in fact has actually had a past couple of really good weeks, hasn't it? So we'll have to see what happens here if, as and when, it gets back to its HB2. For now, though, we certainly would want to hold. NVIDIA actually had a one breakpoint setback, but look how fast the balance sheet is growing. So we tend to stay with companies that are this fast growing. Although I do note that the earnings projections are slowing down. I think if it fails to hold at the HB6 or 33 times book value, we may well reconsider our holding here. Apple, well, we've already talked about Apple extensively, but I wanted to show you what actually happened in the past week as it leapt back to its HB5 or 26 times book value and is holding here. Of course, what we know will happen with these share buybacks is that the slope of these structural breakpoints are going to change from up to down. And when we measure the return on equity, as I showed you last week, I think we will see that Apple looks pretty interesting. Finally, Tesla rather, on Elon Musk's visit to China and report thereof leapt to its HB1 from actually below its bubble price, or 7.4 times book. However, subsequent to that time, I think that investors are kind of rethinking what does it actually mean in terms of sales and earnings for Tesla. And there is some rethinking going on. Now, to briefly recap what happened last week, and more to the point, why. It's been a good week for the FANGs in general, with a single exception, Tesla. Of course, I was especially pleased to see Apple turn around and start to rebound. It has some work to do to retrace its footsteps back over its HB5 price, that's 36 times book, but I also anticipate that coming sharebacks will render this a moot point as those structural breakpoints head lower once again and the equity on the balance sheet disappears, and axiomatically, of course, the return on equity heads higher. Amazon, Alphabet, Microsoft, Netflix, and NVIDIA are staying within their current boundary limits, and I would have no reason to do anything else but to keep a hold buy on these stocks. Although you do need to watch to see what happens if, as, or when any of these stocks reach their next highest breakpoint, higher breakpoint. That leaves Meta as a bit of a dangling participle, although it has managed to scramble back on side. Now, there are two things for you to keep in mind. First, you can very easily assess the risks that you are taking when you own any stocks that looks like one of these. That is a stock which is trading well above its fair market value measure. This issue, this challenge, this problem has always been resolved in the past by the share price coming down to the fair market value measure, and often below. But the operative word is sooner or later, often later, especially in bull markets. Now, second, that means that in bear markets, you should shoot first and ask questions later. That is, sell first when you get an SVA sell signal and find out why You and I, we have already had two powerful examples of this phenomenon, Meta and Netflix, in the past couple of years. So stay tuned and never let your guard slip with speculative stocks like the FANGs are today. Remembering that, allow me to observe that if you are holding other highly valued stocks, you may seriously wish to consider a subscription to our service. It may well be the cheapest insurance that you ever took out. Anyway, that's all for this week. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.